Hello everyone, welcome to video 5 where we discuss working capital. So working capital is one of those items that probably people have the least understanding of and what it is and how it works in terms of purchase price. So just to quickly recap, so we've been over this in previous videos. So far we've been through a calculation of headline price, which is essentially either or typically based on a multiple of earnings. It can also be based off a DCF analysis. Then we get to the price adjustments where working capital sits. So the obvious one and the most common one is a net debt adjustment, which is essentially the difference between debt and debt-like items less or offset by any cash in the business. Now working capital is a little bit different in that it's not a dollar for dollar adjustment like it is for net debt. For example, if there's $10 million of debt in the business, we take $10 million off the purchase price. Working capital doesn't work like that. And there is probably a bit of variety in terms of how it works depending on how the actual SPNA is drafted, transaction to transaction. But the most common kind of approach is to working capital is you do financial due diligence and you figure out what is the normal working capital level. So basically, think about it like a car. So you're buying a car, you're going to need some gas in the tank to drive it out of the dealership, get around, etc. But obviously that's a cost to the seller. It's money that's trapped inside the car. So we need to figure out, okay, what's a normal level of gas in that car, enough that you can kind of drive it around and not have any issues. So you're not necessarily saying a full tank of petrol, but maybe if you've got kind of like half a tank of petrol, that's kind of the average required level to drive it around and do your business, and then every now and then once it kind of depletes a little bit, you can top it up with fuel. That's an analogy. That's essentially how working capital works, is you kind of figure out what your normal working capital level is, and then at the time of completion or settlement, another word for completion, basically what you do is you do a recalculation of working capital and you say, okay, how does that kind of relate to your normal net working capital? In most instances it'll probably be just within that normal range. And it's very important to be very specific about these things when you're actually dealing with the SPNA and calculation, because kind of, what is normal? You're talking about very generic qualitative terms, so you just need very specific numbers in calculation. So if it's above this number, then the party pays the difference between the normal net working capital amount number, which is specified, and the actual calculated amount. And we're also going to be very specific about how you actually calculate working capital, so net working capital, like what items are included, what items are excluded, and so forth. Because this is probably the one main area where there's the most kind of debate. So that's net working capital. In most situations, you might not have any adjustment at all for net working capital. But yeah, as I mentioned, it's just important to be specific about it. So another reason why we have a mechanism working like this is, when you pay the headline price up here, you're assuming you get some things for that purchase price. So one of the things is kind of PP&E. So we don't adjust anywhere in this mechanism for PP&E. Another thing is intangibles. You don't kind of adjust anything in here for intangibles. The reason is because if you're already paying $100 million for the business up here, like what are you getting, right? You must be getting the intangibles, the things that generate the EBITDA that you're buying. So the things that generate the EBITDA are, your machinery, the premises that it's on, if it's owned and part of the deal, like the intangibles, like the brands, the goodwill, etc. Working capital is similar in that regard, which is why we don't adjust it dollar for dollar. It's that it's assumed that when you're paying for it, you're including the kind of the current assets and the current liabilities of the business that are in there that are required to generate those profits. So, for example, inventory is a good example. That's part of the business, and that's part of kind of what you need to sell, right? Now, the one exception to that rule is when you're dealing with small businesses. So small businesses operate on a cash basis. In those situations, there might be a different way of accounting for working capital where you do a dollar for dollar adjustment. And the reason is large businesses operate on accrual accounting. Small businesses often operate on a cash accounting basis. So when I say small business, I mean like your small like mom and pop businesses that are your corner stores or your optometries, your veterinarians, your small GPs, but not like the large chains, for example, because there's certain size thresholds, which we'll touch on in the accounting section, where above that you actually have to start reporting on an accruals basis. Now, again, I mentioned this already, but we'll touch on this in detail in the accounting videos, but essentially accrual accounting reflects costs for things that aren't necessarily on a cash basis. For example, movement in inventory to reflect like obsolescence, for example, or kind of bad debt write-offs. Another good example that kind of ties working capital to accrual accounting and cash accounting is kind of your leave balance. So in a small business not doing accrual accounting, there wouldn't be any expense in the P&L for that. So basically the journal for accounting for leave liability is essentially debit leave expense, credit leave liability. So in a small business they wouldn't have that journal, and therefore their EBITDA would be higher, and therefore you'd be paying a multiple of that. That's why you also need to adjust it for it dollar for dollar in the price adjustments, because otherwise you're double dipping. In accrual accounting, you've got the journal, right? So that means your EBITDA is already lower, which means you're paying a low headline purchase price, and therefore you don't adjust for it in the purchase price adjustment. So that's the other reason we don't adjust dollar for dollar working capital. Okay, so let's move on about going through the detail of working capital. So as I mentioned before, working capital is probably the one area that the least people really understand, and even kind of, accountants with a few years experience, some of them even them kind of struggle with what is working capital or net working capital. And the reason why there's such a big challenge in people understanding what it is that there's no actual universal definition of working capital, and that's inclusive of law or accounting standards. So if you look at IFRS or GAAP, neither of them actually specifically say working capital is this. And the reason is that it's kind of different for every business. It's depending on what industry is, how mature it is, kind of even the operating mechanisms business to business in the same industry. One might be more efficient or employ a different kind of mechanism. For example, one computer chip supplier might operate a just-in-time method, which means they won't necessarily have any inventory on hand, versus another one which stockpiles a huge amount of inventory. Same business, same industry, but just the way they operate, they're going to have vastly different working capital. Okay, but even if you might still be wondering, okay, well, I still don't really understand what you mean. That's okay, we'll get to that in more detail in a moment. So accounting textbooks typically refer to working capital as current assets less current liabilities, but anything in terms of beyond that, in terms of what do you include, what do you exclude within that definition, is a matter of interpretation. Again, coming back to that idea I mentioned about how working capital it really varies business to business, industry to industry. And even within the same company, there's different interpretations about what is working capital and what isn't. So working capital, as we've discussed so far, is really important in terms of building the valuation model, not only in terms of just the actual calculating the purchase price, but also the actual DCF model that you're calculating, because working capital is a cash item. So for example, if you assume that, let's say you're an optometry group and you purchase inventory, right? Luxury frames, and currently the terms from suppliers are like 200 days, which means you get the inventory that you can sell. You don't have to pay it for 200 days, right? That means you're not actually getting much of a kind of cash outflow during that period. You're getting a, yeah, that's right. So you're not getting a lot of cash outflow because you don't have to pay your suppliers, but you're getting cash inflow during that period. But you might model out, okay, those terms might actually change and the suppliers might crack down and bring that down to 100 days. So the impact on that change in working capital, or that one item in working capital, is going to impact your cash flows. And because cash flows are so important in terms of modeling out a business, including the DCF, which is discounted cash flows, it actually has a big impact on the valuation of the business. So what does it actually include, right? So I used the analogy earlier about it being fuel in a car, and that's really a good analogy because it's essentially all of kind of the items in the business which relate to normal trading activity that will crystallize into cash inflows or outflows in the short term. So it's essentially the fuel that the business needs to run on in the short term to kind of achieve its outcome. So you think about it, it's going to be things like, obviously it depends on the business, but it's going to be inventory, right? You need that to sell. It's going to be your AP, right? Your accounts payable and your accounts receivable, right? Because you need to pay your suppliers, and accounts receivable, you need to collect the cash from customers. Could be things like prepayments, right? As long as it kind of converts to cash on a regular basis and kind of linked to the normal trading activity of the business, then it would be considered working capital. So some other examples from the balance sheet could be accruals, could be other payables, etc. So any item, so typically it is, per the accounting status, it typically is current assets and current liabilities, but that's not necessarily the answer. And you might have some assets which are outside of that, which are included, and you might have some assets and liabilities inclusive of this, which might be excluded, simply because either they're not part of normal trading activity or they don't kind of regularly crystallize into cash inflows or outflows. Okay, so going through this and kind of the standard items you would include in working capital, so your inventory, trade receivables, trade payables, your prepayments, your other payables, accruals, some other assets. Even using those, there's still room for interpretation. That's the problem with working capital, and why it's so difficult to understand is that there's not necessarily any right or wrong answers. And what the buyer may view as working capital may differ from what the seller views as working capital, particularly when you take into account their kind of conflicting interests on the deal, with the seller wanting to maximize the purchase price and the buyer wanting to minimize the purchase price. So the correct answer at the end often comes down to negotiation and what is just agreed by both parties to get the deal done. So how do we understand working capital and interpret it in the context of the business? So I like to look at it visually as well. This helps me kind of understand it. So any kind of business is a network of moving parts, and depending on when you kind of run your calculation of working capital, it might change quite substantially day on day, week on week, year on year. And the reason is, businesses go through cycles. You might have periods where you've just paid down, your AP. You might have periods where you get a lot of cash coming in from suppliers, and that's not necessarily going to impact your P&L necessarily, because the P&L is done on an accruals basis, not a cash basis for a large company. So this is completely independent of that. So if we have a look at this diagram and look at some of the kind of key elements, so I think you're starting to get a good idea as to what can be included in working capital for your average business. And you're also starting to get an idea that that's not necessarily the conclusive answer for all businesses, but you really need to look at your business that you're looking at. What's this industry? What's this life cycle? What actually happens on a day-to-day basis to actually come up with your definition of what is in working capital. But yeah, again, some of the key items we touched on the previous slides. So supplier and customer relationships, inventories, accounts receivable, accounts payable, supply chain items, treasury and financing items, and any other kind of cash flow items. So this is where due diligence is really important to come in and really understand that, both in terms of kind of understanding the actual numbers on the page, but the other side is actually really understanding the business. So talking to management, understanding, how they operate, what is part of the day-to-day. Do these items, are they non-recurring, or do they actually form part of, regular business, and do they actually crystallize to cash on a regular basis? Because those are kind of the key critical elements to form kind of your working capital. Okay, so now we kind of understand a little bit better what is working capital. Let's touch on in more detail why working capital is so important. So the first one is the link between cash flows and profit. So we touched on this at a high level earlier. So generally when we value a business, it's based on the future cash flows they expect to generate. So even if we're valuing a business based on a multiple of earnings, so in this slide here, even if we're valuing it based on a multiple of earnings, in almost all transactions, we're also going to simultaneously do a DCF analysis, because that's going to give us kind of our range. We're just looking at the cash flow and saying, okay, based on our own expectations, which we don't necessarily need to communicate to the seller, this is probably our range that we can factor in and still get our required return to pay a multiple. And then so that's basically your value, and this is essentially your price. So this is the amount you actually end up paying, and this is going to dictate you in terms of kind of what range you can actually end up paying. So there's a strong connection between that DCF, i.e. the cash flow of the business, and working capital. And as I mentioned before, kind of when you do your DCF model, a key part of that is the link between kind of your EBITDA, which is kind of a high level proxy cash flow from your P&L, to your cash flow. And some of the key differences is your working capital changes. So I gave the example earlier about an optometry supplier, and we're worried that the provider, and we're worried that suppliers of that optometry group are going to change their terms and reduce the number of days. So if we were to model that into our assumption, it's going to have a big impact on our cash flow, because it means that we're no longer going to have inventory at no cost to us or no cash outlay to us for 200 days. It's going to go down to 100 days. That means there's 100 of those days that we're not going to have the cash for that inventory if we haven't sold that inventory. So these kinds of movements, and that's just one example, but we also need to model out any assumptions that we think might change in your debtor collection days, your payable collection days, your inventory turnover, etc. Because they're all going to have an impact on the cash flow of the business. So most of the due diligence that we'd engage kind of an external advisor like KPMG or EY to do is really focusing on that kind of EBITDA and accounting profit, because that's kind of the key focus, as that is going to determine our headline price based on the multiple. But it's also important to ask them to look at the cash flows of the business, because that's going to then dictate the valuation model. And part of that analysis might be helping you get a good idea of working capital, both for your model, but also kind of your calculation of purchase price at completion. And including, we'd ask them to look at identifying any non-recurring and one-off items which might have impacted working capital in the past, thereby revealing the underlying working capital requirements of the business. So this is kind of what we'd use as our base case going forward. And also to help us understand what are the key drivers and trends of that underlying working capital. Is it increasing over time? Does it have a lot of seasonality or cyclicality that we need to factor into our model as well? Okay, so second point why working capital is so important is from a financing perspective. So just like we talked about in the earlier slides about net debt, if we don't correctly identify net debt, it's going to have a big impact on our financing of the business, because it's essentially a cash outflow at some point in the future, which we'll have to fund some way or another. And some deals are funded via equity, and that's all the equity that they can contribute. Others are by a big fund like a PE firm. Yes, they can provide that if there is an overrun. But other firms that they outlay this amount of money for the transaction, and they can't afford anything above that. And that's a very dangerous situation, because they're going to need to seek financing elsewhere or potentially go bankrupt because they can't finance that debt or that outflow obligation. So it's similar for working capital, but probably not as extreme. But some businesses which are very working capital intensive, maybe that number is very material. So it is something we kind of need to take seriously. So if we get our working capital assumptions wrong in our business, so we've modeled out our future cash flow and we've failed to take into account, for example, that change in supplier terms, or maybe there's a large kind of maybe there's a decline in inventory turnover or something, which is going to result in significantly less cash staying in the business, which of course we need to fund somehow, because the business will need cash for other obligations, paying its employees, for example. So if there's not enough cash because of a change in working capital terms elsewhere, we need to contribute cash either through debt financing or equity financing of the business, just so they've got cash to pay their bills on a regular basis. So buyers of a business need to help ensure they have adequate financing facilities in place to invest in the ongoing working capital requirements of the business as it grows, accommodate swings and fluctuations in working capital arising on a seasonal, even on a daily or hourly basis, depending on the nature of the business. So this is a really important point as well. And it links into what I was saying earlier about how when you're calculating net working capital on one day, it might substantially differ from how you calculate it on the next day or the next week or the next month or the next year. Right, and the reason is because of just timing, and there's so many different elements, positive and negative elements in cash flow, which is kind of changing it. And a lot of businesses operate on a very kind of seasonal or cyclical basis. Think about retail having a big influx in sales, for example, in December. And if we're not conscious of that kind of change over time in working capital, which we should really map out on a monthly basis, if we're, for example, modeling it out on a kind of a trough period, and we assume that's our baseline going forward, so we model that out. Actually, there's a diagram in one of the future slides which might help visualize this. So we might maybe we're doing this in January and say, okay, so our net working capital requirement is this number here. Let's say it's negative $100,000. That's the normal. Okay, so let's model that out. So essentially, we model out a straight line assumption from there for the next 12 months. But what happens is, we actually need to contribute a significantly more money into this business, because as you can see, we're actually modeling this off a peak. And if we'd known that net working capital had increased over this period, we would have been able to kind of see that risk and set aside funds for that risk. But instead, we haven't identified that, and we've got to inject money into the business at a later date. Okay, so that's why financing is kind of one of the key reasons why knowing what your working capital is and kind of the seasonality and cyclicality and forecast of that over time is so important. So the third reason why working capital and understanding working capital is so important is for opportunities for cash generation. So understanding the business and kind of where the weak points and inefficiencies are, particularly if you're working in something like PE, is really important, because you can extract additional value out of that business by identifying opportunities to help manage working capital more effectively. So for example, if we identify that this company's supply terms are 30 days, but the industry average is 60 days, we could increase that, retain extra cash in the business for another 30 days, which we can get a return on. We can invest that. We can buy more inventory to sell more goods, whatever it may be for that particular company. That's just one small example. But understanding those drivers and movements in working capital will help you identify and assess these opportunities relative to your company and your industry, etc. And of course, as I mentioned, this is likely to be business specific. There's not necessarily a couple of standard rules you can apply to any business you're looking at. It's really just looking at that specific business, understanding all the factors, maybe doing some benchmarking and then determining a strategy based on that. So one example is a buyer may be able to negotiate better credit terms with their suppliers. So I gave that example already earlier. So one way we could do that is we could compare those credit terms with that of competitors and other benchmarks in the industry and say, hey, everyone else is paying 60 days. Why are you paying 30 days? And there's a way to kind of improve your working capital. So some other common strategies could be, initiating a more rigorous collections process, negotiating improved terms with key suppliers, supply chain efficiencies. For example, you might implement, just-in-time methodology, improved cash flow forecasting, and so forth. So the fourth reason why understanding working capital is so important is because managing working capital at completion and related purchase price adjustments will actually impact how much you pay for the business. So it's really important to get a good understanding of what first of all, what is the history and kind of taking out the non-recurring items, what is your kind of underlying working capital, what is the normal, and how is it trending over time? Because if you can see a trend and you really have a good understanding of what underlying working capital is, you can kind of forecast what it's going to be at the time you settle or complete the business. And this is going to help you in many different ways, including some of the points we touched on earlier, including kind of your financing and having money aside in case of any changes, but also from a purchase price perspective, because as I touched on earlier, there's typically in an SP&A an adjustment to the purchase price for the difference between the net working capital at the time of completion less your normal net working capital. So just ensuring that you're knowing what to expect so you can set aside funds, but not only to fund the working capital, but also to, if you need to, put in more money into the purchase price, or if you're the seller, potentially expecting less on your purchase price at the time of sale. So some of the kind of value adds that we can do when looking at a business in terms of working capital from the perspective of the purchase price adjustments is, as I mentioned before, the mechanism with the counterparty that you're agreeing needs to be super specific, and we need to be across this to make sure that they're not getting an unfairly good deal. For example, the person selling the business has a really good understanding of cyclicality of the working capital, and they know, let's say they're completing in January, they know that it's maybe a peak month. So if we're saying, that, net working capital is low off a trough month, they're going, okay, well, I know that I'm going to settle in January and get a big uplift on the purchase price. It could also be about kind of what we're including as definition as net working capital inclusions, because the SP&A is going to be very specific about, they'll go down to the level of identifying specific account names on the balance sheet and saying this is working capital, this is not working capital, this is working capital. And then the final way that we can approach this to add value is to actually go through the completion accounts when prepared, review the purchase price adjustments, compare it back to the SP&A and add some commentary and value as to appropriateness of including some of these items, and potentially get down the net working capital amount there, and therefore minimize the kind of purchase price adjustment from that perspective. So on that note, what kind of analysis would we typically do on working capital when we're looking at a deal? So again, continuing on the theme that, you know, working capital for every single business is a little bit different, and there's not necessarily any regular themes across every single business. There are typically 5 areas that we would look at in terms of analysis of working capital. So the first one is composition of assets and liabilities. So really looking at the balance sheet and understanding where everything sits from a perspective of assets and liabilities, and, you know, making sure the balance sheet is complete and really understanding every item on it. And that includes kind of an allocation between, as we went through in the net debt video, allocating items on the balance sheet between, actually I might just quickly try and find that slide because that'll be helpful. Really grilling the balance sheet and allocating it between one of these categories. So net debt, other provisions and accrual. So this is kind of your maybe net debt, maybe net working capital, but subject to negotiation. So it's your maybe bucket. Then your obvious working capital items. So the items that are converted to cash within the operating cycle, usually short-term recurring operating items. And then also categorizing any items that are infrastructure or other, which, as I mentioned before, aren't actually adjusted in the purchase price because it's assumed that they're included in the headline price. And then also just reviewing your off-balance sheet items as well in case there's anything missing, which we should be including there. Okay, so let's just quickly going back to where we were. So the next kind of area of analysis is balances to be excluded. So let's say we've already calculated what our net working capital is and we've negotiated kind of, you know, what are the, you know, the 50-50 items. So the next step is to actually say, okay, now that we know what our net working capital is by month over the last, say, 3 to 4 years, there might be a couple of spikes there month to month. So it's really going through it and saying, okay, what was driving this big increase in this month here? So as you can see, there was a big increase in trade debtors. So then it's going through requesting the GL and speaking to management and understanding what drove that spike, because it might have been a one-off non-recurring item. And in that case, we might actually adjust this out and exclude this item from our adjusted net working capital calc. Because at the end of the day, what we're trying to do is finding our underlying net working capital trend that isn't distorted by kind of your one-offs, your non-recurring items, or anything that might be debt-like, which actually isn't a net working capital item. So once we've done that, the next kind of step is to look at trends. So look at the seasonality, look at the drivers. So we really want to understand the nature of the business, kind of what happens to working capital. Is there a regular theme, or is there a trend where net working capital is just growing consistently year on year? So for example, have a look at this one over here. So you can see our adjusted net working capital is the blue one. And then over here, we've got another one, which is we've spoken to management and we've agreed to exclude this. So this is our adjusted net working capital essentially. But let's have a look at the blue line. You can see there's quite a consistent theme there of that growing over time, right? So that's one thing you want to look out for, is kind of any trend over the longer term in terms of what's happening. So you can see it's definitely growing, and that's typically what you'd expect with a growing business as well, because, you know, the larger the business, the more, for example, inventory they would need to have, the greater the value of kind of trade debtors and creditors over time. So that's pretty typical of a business. But the other thing we really want to look out for is there any cyclicality? Do we see a big spike every single December? Do we see a big lull every single January? So have a look at this. Can you see kind of any particular trends in here? I mean, not really, not particularly. There's not really kind of anything jumping out immediately. So what I might do is I might look at every, say, for example, December. Let's look at December because that's often a peak period for companies. So, you know, it's not particularly high in December. What about this December over here? You know, it's not like it's not that different month to month. You can see over here there was kind of a big drop off from November to December, but that didn't really occur in the next year. So I wouldn't say in this example here there's any kind of obvious cyclicality. Maybe there's a bit of an increase in the kind of the month before December and the month, so mid-year months, you could argue. So June's a little bit higher. But it's not really evident in the year before that. So I would say there's probably not any obvious cyclicality here. And probably where you would select your net working capital is you look at kind of what's a normal period. It could be this period, because this is depending on what happened here. If there's a lot of distortions, like a lot of maybe restructuring or acquisitions and things like that, that can really distort the numbers. And you might say, okay, let's look at the pre-acquisition period and look at this and take that as the normal net working capital period, and we'll use that as our basis for the acquisition. So obviously that's just some dummy data in there, but for an average business, that's the process we'd look through. We'd prepare a chart, something like that, so we can just kind of really visually see how that's changing over time. And then we kind of touched on this as well, but it is different in terms of looking at the intra-month balances, and that's essentially where's the peaks, where's the troughs, because that's really important from a working capital perspective as well, because if you think about it logically, is those are months that you're going to have to fund, right? So yes, we've got our average month, and that's what you expect as your kind of average as well. But let's say your kind of accounts payable peaked to $1 million at one point. You're still going to have to fund that out of cash somehow, right? So maybe it's just making sure you've got $1 million in cash set aside for that point in time, and understanding that, because at the end of the day, you'll have to fund those peaks and troughs as well. And then the final analysis is just look at your working capital and SP&As. So that's primarily through your completion accounts, looking at what's included and excluded in your SP&A. So it's important to have your accounting team involved at this point of the agreement, not just have your lawyers, so that they can really specifically say what items will be included in the SP&A. And also your accountants will typically prepare the completion accounts, so just going through that, reviewing that, and negotiate on that to determine what is the actual working capital calculated at the time of completion. Okay, so that's kind of an analysis of what we do on the average transaction. So now we're going to do a little bit of a deep dive into kind of each of those different items that we went through just now, just so you can see it in as an example for each. So the first one is actually grilling the balance sheet and allocating things into assets and liabilities. So typically what we'll do is we'll allocate the balance sheet into those categories I mentioned earlier, which is kind of your fixed assets or PP&E, your working capital items, and your net debt / other items. You'll then so you can see your balance sheet at this point in time, the 30 December 22, that might have been the source data you've been provided by the client. So you just do that so your net assets kind of tie back to the source data. You then might kind of want to do a separate column over here where you just extract the net working capital items, just so you can see what the total of that is, and include that in your SP&A as your normal net working capital. And you might do the same for net debtors here, so you can also kind of identify what your not net debt items are for the purpose of the purchase price adjustment as well. So the next item that we discussed earlier was actually looking at any balances from this to be excluded. And these are typically 3 categories. Number 1, debt-like items. Number 2, non-recurring balances. Number 3, one-off items. So what I would probably want to do is get the GL for each of these. I might also want to look at probably a longer historical period than just 1 year. So I might request 3 years of monthly data, just so I can look through and look at the trends. If there's an item in here which has only occurred in December 22, but didn't occur in 21, 20, or 19, I'd probably say, well, I'd ask management first in case there's a reasonable explanation. But my first interpretation was it's probably a non-recurring item, and therefore we'd probably exclude that from our net working capital calculation. Debt-like items as well. So if we have a look through here in working capital, there's nothing here that stands out as a net debt item, right? Inventory is a fairly standard net working capital. Trade debtors, fairly standard. Other debtors, fairly standard. Trade creditors, fairly standard. Other creditors, fairly standard. But here's a common example of a working capital item which could be argued to be net debt or could be argued to working capital, and that's kind of your credit cards. So credit cards is an amount outstanding from the business that you have to repay as the business. So one party will argue that that is net debt, and that's probably going to be the buyer, because they want to reduce the purchase price. However, the seller is saying, well, no, because this is an item which is part of the normal funding of the business. It converts to cash, right? So we're paying it down every month. So, and it changes month to month. So 1 month you might see it as $1,000, and 1 month you might see it $10,000, 1 month you might see it at $0, right? So it's not consistent like you would for a debt balance of, let's say, $10 million plus any capitalized interest. So this is, the seller's going to argue, no, that's net working capital. So another example might be, for example, annual leave liability. So the buyer might be saying, because they want to include this in net debt, they're going to say, well, that's an extraordinarily large amount of leave balance from COVID. We want to include the entire balance as net debt because it's essentially an unfunded liability of this business. And the seller is saying, because they're incentivized to include this as net working capital, they're going to say, no, that's going up and down on a month-to-month basis. It's part of the normal trading of the company, as employees come aboard and leave, and we pay it down as those employees take it, and it crystallizes to cash, and it's recurring, right? So there's two sides of the coin. So it's really understanding each of those net working capital items in there and considering are any of those actually debt and not actually net working capital. And in practice, you're probably going to have a third category, which is kind of like your gray areas, which you'd then go into a negotiation. So you might accept 50% of them and concede on 50% of them. And then the final one, which is fairly similar to point 2, is kind of your one-off items. So I probably won't go into much detail there. It's fairly similar kind of idea there. Just look for your non-recurring because it doesn't actually form part of your recurring working capital, which is linked to your ongoing operation of the business. So here are some examples of kind of some balances to be excluded, which might fall into one of these different categories. So capital creditors. So this is something that represents payables due for fixed asset purchases. So this liability does not finance the ongoing operational needs of the company and therefore kind of wouldn't fit into that definition of working capital that we've discussed. Intercompany balances is another one. So this is an item that won't continue post-transaction. So things like accrued management fees, loans, dividends between related companies in the same group. However, items that will be replaced with third-party suppliers post-transaction should be included. So for example, if you've got a related party which supplies kind of inventory, you probably wouldn't include that, but then if that loan is then going to transfer to an external party which isn't a third party, it would then consider to be a net debt item. Next is long-term assets liabilities. So, remember working capital is more about that regular conversion to cash in the business, which is linked to your, ongoing recurring operations. So anything that's long-term probably isn't crystallizing to cash in the short term, probably not linked to the ongoing, business. It's probably just something that's sitting there on the balance sheet and probably is a net debt item. And there's an important sub-point here is that there may be a current component to one of these non-current assets. For example, there might be an accrued interest component. You'd probably want to exclude those because it is ultimately linked to that long-term asset, which is excluded. So deferred taxes is an interesting one. So it's essentially an accounting entry, and it doesn't necessarily result in short-term cash flows. So therefore, probably wouldn't be included in working capital. Income taxes payable is another interesting one, and again, this one might, depending on how the negotiation goes, it might go as a working capital item, it might not. So this might depend on whether these liabilities transfer to the new ownership of the business. If there's a large kind of unpaid income tax liability, you could actually include this as net debt. But if it's just part of kind of like your regular taxes, which go in and out, you could argue that it's a working capital item. So if there's a current tax obligation, which is regular, you could argue that that's working capital, but not your non-regular, non-current, irregular kind of tax liabilities. That's probably a net debt item. Next is your non-operating current assets and liabilities. So this could be, for example, receivable from the sale of a building or a sale of a PP&E. So we're excluding this because it's non-recurring, therefore it doesn't form kind of part of your underlying working capital. It doesn't link to normal business operations, therefore we wouldn't include it. Next is restructuring liabilities. So again, this is probably a non-recurring balance. It's typically a one-off occurrence. Insurance claims, typically a one-off balance. Could be a net debt item depending on the nature of it. And then discontinued product lines. So this is a really interesting one. You probably won't come across this too often, but in a scenario where a business has kind of, let's say you've got a chip maker and they've got a whole bunch of chips which has been discontinued, won't be sold anymore. What's the impact of that inventory? Because they're going to have a lot of inventory sitting around which is obsolete. Do you kind of include that in the net working capital or not? So the typical approach would be to analyze the inventory related to that product and probably write it off because it's obsolete. It's not actually, it's not part of your regular inventory on at hand, which will crystallize to cash. It's probably something that will sit there and not get sold, not get crystallized to cash, and just go to obsolescence. So you'd probably want to adjust for that. So as you can see, I mean, the common theme is that just looking at the balance sheet by itself probably isn't enough for you to calculate net working capital. It requires you to really understand the business, really speak to management, run them past all your queries and your gray areas to really get a good understanding of what are the drivers of the business and what is the current net working capital. So some other items to consider. I mean, this is not conclusive. There's many potential items which are in the gray area, which could be net working capital, could be net debt, could be other. So just a few common things that come up. So cash in transit is an interesting one. Now, do you include this as a cash balance, which forms part of net debt, or do you include this as net working capital? So where a proportion of cash is in transit, we might want to include as a net working capital item, since it represents cash tied up in the running the business day to day. So for example, cash float in the retail businesses. So remember when we were looking at net debt and we looked at cash within that and we said, you look at cash in the business, but you exclude any trapped cash. So trapped cash can include cash in transit and can include cash floats like money in tills, or it could include escrow payments. Escrow payments, that's a tricky one. Do you include that as a working capital item? Well, it's probably non-recurring if it's linked to kind of like a one-off sale of a building. But if you're a real estate agent, you might constantly have that escrow balances. So that might actually be considered your working capital. Next is deferred revenue. So where deferred revenue is not usual under normal operating conditions or is over a long period, we may consider classifying it as debt. However, it's if it's a regular part of your business that you do have deferred revenue in there, then you probably want to include that as a working capital item. So an example of that might be subscription-based businesses, which are usually a year, but some customers have much longer contracts. Capex liabilities is another thing to consider. So these are often excluded from working capital on the basis that they are not related to day-to-day business operations. In a particularly capital-intensive industry where ongoing Capex maintenance and renewal is typical, we might consider including them in working capital. So this is where it's really important to differentiate Capex, and we typically look at Capex in two categories. One is maintenance and one is renewal. So maintenance is, let's say you operate a dental practice. So maintenance might be, you might buy every single year, you might buy the same kind of mirrors, you might buy the same kind of scalpel. I don't know the technical terms for their little devices, but we're not talking a huge amount of money here. We might be talking like 1% of revenue a year just for kind of replacing your very basic assets. Now that's recurring, it's the same amount every year, it's fairly consistent, it's linked to your day-to-day business operations because you need that to provide the service. That would, even though it's arguably Capex because it's a capital item, that would actually be considered part of your working capital. However, for most Capex that you probably consider what Capex is, for example, buying plant machinery, buying cars, buying even a property, doing a fit out of your store. Most of those you don't do on a regular basis. You might do it once every 2 years, 3 years, 5 years, 10 years, or even like 20 years, depending on the asset. That's obviously non-recurring. It's obviously not linked to your day-to-day business operations. So that's actually Capex that would be considered, on the balance sheet side, and we might actually include a net debt adjustment for that because there's a capital outlay expected in future and therefore a liability for that payment. Okay, so the third item that we looked at before in this slide over here is historical trends, and I might actually link in the fourth one here, which is intra-month balances as well. So, if we have a look at some typical analysis, so most FDDs, and you probably want to do this internally in-house as well, just for your own benefit, is what you do is you grab the balance sheet on a monthly basis for every item that you've categorized as net working capital, and you might have all of them up above on a monthly basis and calculate kind of at the bottom a total of those to calculate your net working capital. Now you might have another set of the numbers even below that where you'd actually kind of do your normalizations and pull out kind of your one-off non-recurring items and any kind of other adjustments that you're doing in there to get to your adjusted net working capital. And then you essentially do a stacked bar chart. And we'll cover how to do something like this in our kind of Excel video course a little bit later. So you can know how to chart one of these sophisticated and good looking charts. But this is what you'd do. And then you'd kind of look at the trend over time. And as I mentioned before, it's kind of looking at that line over here, seeing where that's trending over time, because this is essentially how much cash, that line there is essentially how much cash is locked up in the business. And from another perspective, it also reflects how much money you need to fund in this business. For example, look at these peak months. So what's driving this peak month? So they've got, or maybe have a look at this one, trade debtors, July 2012. They have got $1.5 million of trade debtors. That means that they've done these service for clients, they've recorded it as revenue, but they haven't received cash for it. So that means there's $1.5 million of cash locked up on the balance sheet as a receivable, which they don't have. So it also means that, if they have to fund other things in their business, their regular payroll, they're going to need to fund that some other way, right? And the risk is if all this money is locked up on the balance sheet, and they have other obligations at that point in time, like payroll and, other P&L expenses, they're risking, insolvency, right? Because, how do they get the money to pay for that thing? Essentially, they're going to have to go bankrupt. So the alternative is the owner of the business actually has to put in that capital, and then where does the owner get that capital from? They might also have, cash flow issues where their capital is locked up. So it's just really understanding those dynamics and having a contingency for that. So it's about understanding not only kind of where is it trending as it, in the long term, both from our modeling perspective and net working capital for the purpose of the SPNA purchase price adjustment, but as the secondary point is looking at the fluctuations between peaks and trough. Because as I mentioned, in this July month, 1.5 million is locked up. They need to be able to fund essentially $1.5 million into the business to be able to do other things, because that's $1.5 million of cash that they don't have otherwise. So there's several metrics and analysis that help us understand historical trends in working capital. So peaks and troughs, so that's basically the highest and lowest working capital points of the business. We've got KPIs, which is essentially, for example, how long does a business, sale or purchase take to convert into cash? So these are just helpful benchmarks for us to understand how efficient the business is operating at, how does it compare to competitors, how does that change over time, because that's going to help us identify, okay, is there anything that we can do to improve net working capital over time? So some examples of this could be days sales outstanding, so how many days it takes for a sale to convert to cash. Days payable outstanding, this is, how many days does it take for the business to pay its, accounts payable? And, for example, we might look at a business and, their average days payable outstanding could be 30 days. And, that seems reasonable. And then we look at the kind of the payment terms on an average invoice as part of this, part of our due diligence. And those days are 60 days. And we say, okay, well, why are we paying our invoices 30 days early? We could be holding onto our cash for an extra 30 days. And if something comes up, it just means that there's cash there for us to fund it, that we don't need to fund through our investors or risk kind of insolvency, etc. So the next component that we kind of metric and analysis we look at is seasonality. So really important to understand. Some businesses have no seasonality. Some businesses have extreme seasonality. So what's an example of a business that might have extreme seasonality? Well, what about Christmas tree farmers? People who sell Christmas trees, right? So for 11 months of the year, they're growing these trees. They're not receiving any cash, but they're paying, outlays for kind of your, any expenses that have occurred during the year. Then during December, all of their cash is coming in during that year. All of the sales is coming in. So for 1 month of the year, they're going to have a massive spike in trade debtors. And then every other month in the year, they're going to have probably negative net working capital. Okay. And then just to finish off this slide, so we've talked about historical run rate, kind of which way it's trending up or down. Averages is another one as well. And these ones are probably, the last two are probably more relevant in terms of calculating what your normal net working capital is. an important concept because that's the key hurdle which determines your purchase price adjustment. And we might kind of present this when we're doing the analysis in a table like this, where we've got kind of our average, we've got our peak, we've got and what month that actually was. If it's December or end of year, it gives you a sense of timing. This is probably in conjunction with the chart as well. And then we'll do the same for trough. So the low month, 10.9, 8.9, and then March, what month it was, and then what the swing is between the peak and trough, which gives you an idea of kind of what is the size of the swing between peak and trough, which is essentially you need to fund that difference at some point in time. So the other way we'll kind of cut the data is in ways like this. So we might just do a single line chart like this, where it's essentially the blue line in here, but without the background distorting it, and we'll kind of just highlight where the peaks and troughs are, so you can very clearly see timing and how extreme that difference between peak and trough is. We might also do this overlay chart like this, where instead of doing it as a kind of every month side by side, we'll do the 3 years overlaid, so you can really start to see the patterns in seasonality a lot easier than you could with something like this, because trying to match month by month is quite difficult, right? Then you got to look up, say for example June, and seeing, okay, what's the trend here to here. It's quite hard to see. But in a chart like this, where you've got each year on year, you can clearly see that June is a peak month for net working capital, Feb is a low month, and that there is a clear seasonality for this particular business. And we'll also probably do a table like this, where we've got our kind of by year or whatever period we're looking at, the min, max, average as a percentage of the last 3 month revenue, and then some of the KPIs we talked about. So the key obvious ones are inventory days, debtor days, and creditor days. So the purpose of this is a couple of reasons. So peaks and troughs, we need that for financing perspective. Particularly if you're a PE buyer, you need to consider how you're actually allocating your capital. Any kind of shortfalls in net working capital we need to fund, or the business needs to fund from somewhere. And then the peaks and troughs, of course, is just kind of the differential between, at some point in time, we're going to need to fund that as well. And seasonality is really just to kind of help with our modeling. We can model that into future, but if we're just initially doing our calculation based off a low month, the risk is if we don't understand the seasonality, we won't correctly model out in any kind of increase in net working capital needs. So some of the key KPIs we've discussed, so days sales outstanding, days on hand, which is inventory days on hand, and then days payable outstanding. These are kind of the 3 key KPIs we look at, because if any of these are out of whack, we can either look at inefficiencies in the business and the ways we can improve that post, or if the business is very efficient, we might say, okay, well, there's probably not any room for improvement. So this slide essentially just kind of shows you how to calculate each of those. So days sales outstanding, I'm not going to go through in detail, you can see the formula there. But the benefit of these is we can actually compare them against things like invoices. So days sales outstanding is your trade receivable. So someone doing this due diligence can actually pull out a kind of sales invoice from the company and say, okay, what's our kind of terms on our invoices? And then, maybe there's some room for improvement there. And then vice versa for days payables, we can look at the days payable on our kind of AP and look at what the terms we're getting on our invoices and say, okay, well, there's room to actually withhold that a little bit longer and improve our net working capital. And then days on hand is essentially how long we're keeping inventory on hand, and maybe that's, if this is high, maybe what we can do is just do like a just-in-time inventory system, or maybe look at kind of what our processes are. Maybe we should keep less inventory on hand, for example. Okay. So why do we look at historical trends? Well, primarily from 2 perspectives. Number 1 is from forecast, and number 2 is for implications on completion. So this is really just to summarize some of the key points we've already made. So from the perspective of kind of forecasts, it's really understanding about kind of the trends in working capital, the movements in those KPIs, where is the room for improvement, where are the inefficiencies, where are the efficiencies that might not improve, and then as a basis to just really modeling that out over a long period of time. So it's really important to understand those drivers, the seasonality, the peaks, the troughs, the changes, to accurately model that. And then secondly is from the perspective of completion. So we talked about several times already why it's so important, because it actually impacts the purchase price. and really understanding what and agreeing correctly to what is the normal net working capital, and then calculation of net working capital correctly on completion, really important because it's going to impact your actual calculation of purchase price. Intra-month balances. So why are these so important? So it's this kind of feeds into the peaks and troughs argument. So it's kind of understanding the month-to-month changes, because ultimately this is a reflection of changes in cash flow in the business as well. So it's really important to understand that, map that out, ensure that those the changes are adequately funded. So we've got facilities in place. So typically this might be, you might go to the bank and say, put in place a working capital facility. This is essentially a short-term debt facility which moves up and down with net working capital, but that's why it's really important to understand the peaks and troughs, because the peak is essentially going to be the most you can essentially borrow in this working capital facility. If it goes above that, then you're going to have to fund it in some other way. So here's an example of analysis that we might do on intra-month balance. Again, it's feeding into kind of some of the charts we've already done before, but this is just showing you it in absolute completeness over a longer period of time. So it's important not to just look at 1 year, but multiple years, and kind of see where those peaks and troughs are, and really understanding what was driving those, whether it was really an underlying and recurring net working capital change, or if there were kind of non-recurring elements driving that. And being this really good at helping you identify those kind of non-recurring elements, because that typically does result in a kind of peak or trough to the net working capital. So let's talk through this theoretical example that we've got above. So this example above demonstrates the cash flow cycle for a particular company within a month. So payroll payments are made twice a month, approximately around the 6th and the 15th. Customer collections are also made twice a month, around the 13th and the 21st. And there are 2 supplier payment runs on the 6th and 22nd. So if a buyer acquired this company on day 1, there are 2 cash outflow obligations within the first week before the first collection from customers is made in week 2. Therefore, our advice to the buyer would be ask the vendor to leave enough cash in the business to meet these 2 obligations, or set up a revolver or overdraft facility to put in place immediately. And this advice might be particularly more useful to a PE client, as they don't usually have a treasury function built in or a cash pooling arrangement in place. A strategic client may have cash funds that can be transferred around the group. So for example, if you're talking about like a Woolworths acquiring like a small branded group, that will be okay, because Woolworths has got a pretty deep and comprehensive treasury function, whereas a PE client, they've only got a certain amount of kind of capital allocated for this deal. So it's really important they understand that and don't need to draw more than what was discussed or expected. So just a small example kind of tying together some of the lessons we've covered off already. And then the final one, the 5th one that we kind of talked about, why it's important to understand working capital, kind of going over what you already know now, I think, but it's really just the fact that there is a link between calculation of net working capital and the actual purchase price adjustment. So, SPAs will go in, as I mentioned, will go into a great level of detail in terms of, what is the definition of working capital. So really nailing down, the qualitative or in dispute areas, and just putting a very, very specific definition in of working capital, what the target working capital number is. So that would have been agreed by the 2 parties already, and it would have been, formed off a view from the financial due diligence done, looking at kind of historical working capital, what the advisor views normal, what the trends are, what the peaks and troughs, cyclicality and seasonality are. So factoring all of those numbers, what is that kind of target agreed? Next is the working capital schedule, which is specified in the SPA, and this is a really, really detailed table of what is actually included in working capital. So there's no disputes or confusion once you get to the completion and actually, calculate what's in working capital again. So it'll specifically say in the SPA, it'll say, this is included, this is excluded, this is included, this is excluded, and so forth. And then finally, what the actual mechanism for calculating it, which is typically just the shortfall or excess of target, and how that adjusts for the purchase price. So we'll cover off SPAs in more detail in another video. So now that we kind of know what net working capital is, what the key areas to look at, why it's important, and how we look at it, let's summarize that with just some top 10 tips for kind of understanding and analyzing working capital. Number one is it's really important to be really clear about working capital definitions. And this is because, as we've learnt now, that working capital, there's no specific definition for it in law or in accounting standards, and there's a lot of interpretation open to it because it does vary company to company. So it's really, number one rule is really important to be very specific about how we define working capital and just be really clear in the SP&A and in internal discussions about kind of how we're defining it. Number two, be clear about the sources, reliability, and consistency of the working capital information. And this is, again, because there's so many moving parts, because there are, differences in interpretation, differences in calculation, even differences in reliability, right? Because you might be working off a period which has a lot of kind of, it might be acquisitions, it might be restructuring, and that doesn't necessarily reflect the true underlying working capital. So it's really important whenever we're working with working capital information or displaying findings from it, we discuss, what were our sources, how did we normalize it, how reliable we think that is, including and making an assessment on that period as whether that is a good indicator for normal working capital, and consistency. Like if there's a lot of kind of data all over the place, it might not be reliable to use. So just being really clear about that so the users of the information are aware of it and can factor that into the decision. Number three, if possible, cover at least 2 annual business cycles. So the more the better. So we want to kind of work with at least 3 in my view, maybe even 4 for a good due diligence. But at the very bare minimum 2. And the reason is because of seasonality, and also because, we might be working off a period which might be distorted for some reason. As I mentioned before, it could be due to acquisitions, could be due to, rapid growth or restructuring or something like that. So it's the longer, the better, and you can actually find those underlying trends. And seasonality, of course, you can only verify that it's an ongoing seasonal issue if it occurs in more than 1 year. Lesson number 4 is monthly or even weekly financial information is better to quarterly when considering seasonality. And the reason is we really want to understand the timing of cash flows, and sometimes some payments are done on a even more frequent basis than monthly. For example, a lot of companies pay on a fortnightly basis, so it's really important, if we can, although it is difficult, to get information on a more regular basis, just so we can identify, like we did in the previous slide over here, that on a daily basis when payroll payments are made, when customer collections are, and when the supply payments are, because then we can actually match it on a day-to-day basis what cash flow and net working capital will look like. Number 5 tip. So daily financial information may be required for selected period in order to assess intra-month flows. So quite similar to point 4. And then number 6, be aware of any changes in the target business or changes in accounting policy during the period under review. So we need to, so this kind of ties into point 2 up here, in that, we need to understand what's driving the data, what's driving the working capital. Is this an underlying trend that's actually occurring in the business due to the day-to-day operations, or is it driven by something else which is distorting the data? For example, a change in how the business operates, a change in how they're accounting for the numbers. So is it real, genuine, or is it artificially distorted? So understanding that. Number 7, be aware of potential accounting period distortion. For example, 445 periods and 13 periods of account. And number 8, consider comparisons of working capital day trends to industry data or previous deal experience. So again, this is tying back to the very first lesson where, working capital is different company to company. Even just looking at the KPIs of the business, we need something to compare it to understand if the business is normal, if it's being efficient, if it's being inefficient, and so forth. So final takeaways before we finish up and in the next video and discuss SP&As. So what are the final takeaways? So we talked about composition of working capital, kind of how it's made up, the key concept about looking at the balance sheet, really growing it, understanding it, looking for anything missing, and then kind of allocating things into, categories, which I might just bring up the slide quickly, if I can find it. And then, it was in the previous chapter, wasn't it? So really just grilling the balance sheet and understanding kind of all of different line items, and then categorizing it as to net debt, other provisions, accruals, working capital as infrastructure and other, and understanding what is driving that working capital. It's anything converted to cash within operating cycle, usually short-term recurring operating items. So really just understanding that, grilling the balance sheet and categorizing it, including the kind of the maybe bucket, which is used for negotiation, kind of splitting that out so it's a fruitful and structured conversation. The next kind of takeaway is balances to be excluded. So we understand that what comprises working capital, what comprises net debt, and how that can be subject to negotiation. It ultimately comes down to, is it a driver, or ultimately comes down to the definition of working capital, which is essentially part of the day-to-day operations of the business. It's recurring. It'll convert to cash in the short-term cycle. And again, I'd like to refer back to that gas in the car analogy, which I think is a really good way of understanding it. Historical trends, so we talked about that, and why it's really important to understand the peaks and troughs, both from a financing perspective, but also just a modeling perspective. We talked about KPIs, why it's really important to understand those, in particular looking for informing an assessment on how efficient or inefficient the business is with working capital, and the implications of that on your future modeling, including your DCF, which is a key driver of purchase price calculation. Understanding seasonality, because that's going to help with your modeling and also with your kind of financing any peak seasons. Understanding the run rate historically and average, particularly in informing your view of what is a normal net working capital. And then finally, what the impact on completion forecast. So we understand that the typical SPNA will just form a view that there's a purchase price adjustment for the difference between actual working capital at the end versus your normal net working capital. Next, we talked about intra-month balances, why it's really important to understand timing month to month, both of receipts and payments, and about why that's so important, because you need funds in the business to be able to fund those. Yes, the business might be solvent long term, but you also need to be able to make payments of short term liabilities as well, and having the cash available, and not making sure it's just not locked up in the business. And if it is, really understanding that and making sure that we've got available kind of financing facilities available to cover that, your overdraft, your working capital, revolver, etc., or just leaving cash in the business to cover it so you don't run into shit or problems down the track. And then the final category is your SPNA definition completion mechanism. So we now understand, how it works in the SPNA, and a lot of it's just being about really clear about the topic and definitions, just given it is open to interpretation and negotiation. So just being really clear to avoid dispute at that point in time. So hopefully you found this course useful, talking about working capital. And yes, it's a difficult concept. It's probably the one key area that most accountants don't really understand. So hopefully this added some color and clarity into the topic and why it's important. So in the next video, we're just going to discuss the sale and purchase agreement, the actual legal document, and the ins and outs of this, including the key issues. So I look forward to seeing you in the next video, and hopefully you found this useful. So thanks for watching.